Okay, everyone, welcome back to the third of three modules that sit within this trio of new material introduced for 2024 that has basically looks at how to bring together all the skills, the content we've seen before, into the context of what analysts need for producing a research report. So if we remember where we've come from in this, the first one of the three readings was understanding the key drivers of revenue, profit, working capital, investment, and capital structure. The second one was industry and competitive analysis, which was more of the strategic stuff, understanding the growth rates and Porter's five forces, etc. And this last one is just looking a bit more at forecasting. Now, there's actually quite a lot of overlap between the first one of the three and this one, which may seem strange when you're in the position of working through each module as if it's new content. It's kind of the same thing, it's just the scenarios are made a bit bigger. So when you're looking at the underlying material here, it looks like things are pretty big and can be pretty complex. But we've got to remember that we are in the context of a sort of rapid fire multiple choice exam. So it has to be turned into something that's doable and doable within the 90 seconds that you've got for each question, which means scenarios will be smaller, will be manageable. Now, of course, in an exam where every question on average is 90 seconds, there will be some that are bigger and some that are much shorter. So some questions may feel quite big, but it still has to be reasonable, doesn't it? So what we've done in this masterclass, in these slides, is taken some of the CFA Institute examples and just trimmed them back so that all we need to see is the key relationships, the key drivers, without all of the kind of background pages worth of information, because realistically, that's not what you would be presented with in the exam. Okay, so we're looking at the same thing. So if you look at the bullet points there, we've got revenues, operating expenses, hence bringing us to operating profit. We've got working capital, capital investments, capital structure. So they're all very similar, aren't they? Those points really came up within the first of the three modules. Scenario analysis is just a note at the end that we don't have to stick with one central best estimate. We can build different scenarios, we can allow things to move, and that's you've met that in other parts of the curriculum as well. And there's just a little bit more about principles and approaches, which we'll see at the start of the slides here. Okay, so the different forecast approaches are given here, and there's reference to forecast objects, which just means what is the thing that we're trying to forecast. It may be that we can go straight to forecasting a key line in the financial statements, or it may be that we need to look at other underlying information. So the number of subscribers for a streaming service, that will help us work out revenue, but it's a separate thing to forecast. Okay, so your four forecast approaches, you can take the historical approach and assume that perhaps growth levels or margins will stay as they have been. Or you can build in convergence. So convergence is the idea that everything, even growth industries, will converge towards a more reasonable average mature industry growth rate. So we can say, okay, electric car manufacturers are growing, 20% per year or whatever it might be, but it's likely to converge towards a more reasonable 5% or whatever the industry might be. So we build in an element of convergence. Or we may have to go with what management are telling us, because if we trust the management, that is, or we can build it in to our forecasts based on management telling us how many new subscribers we've got in a recent quarter, for example, and we build that into our forecasts. Or the company or the industry may just be so new that the analyst has to be the expert and work things out from first principles. Okay, so we'll start off at the top of the P&L, as we often do, thinking about revenue, but also how, very relevant at the moment, how cost pressure can flow through into margins. And it's just a little example that just stops us from making a statement about how margins might behave without actually stopping and thinking about the relationship between sales and costs of goods sold. Okay, so as we know from 2 modules ago, if we're going to forecast revenue, we can do it from the top down or the bottom up, or a kind of combination of the two. But take a look at these numbers and just pause me for a moment and think, what's going to happen to the gross profit in absolute terms? And what's going to happen to the gross margin as a percentage? Okay, so COGS, or cost of sales, as a percentage of sales is 25%. Output volume is stable, but input costs double. And that's going to be passed on to customers. So input costs will go from 25 to 50. So that increase of 25 will get fully passed on to the customers. Okay, so the gross profit stays the same. But if we're working with margins, the margin actually comes down, doesn't it? The gross profit margin doesn't stay the same. The gross profit margin actually reduces down, even though we fully pass everything on to our customers. Okay, the numbers don't lie, but it might feel a little bit counterintuitive. Okay, so moving down from that, let's think about working capital. It's a bit repetitive from 2 modules ago. It's just giving you a little bit more to play with in terms of background. Okay, so what we've got is this slide, and the following slide gives you your input information. So we're going to work from that. And again, I'd like you to try this yourself and then check your answers with what I go through. Okay, so the ratios can be the forecast object. We can forecast what's going to happen to the ratios and forecast separately what we think is going to happen to the sales and costs. And that leads us to where we think all the working capital figures will be. Okay, so on the slide that is about to come, work out your days sales outstanding, days inventory on hand, days purchases, or if you prefer, work with the turnover figures. As you know from what I said a couple of modules ago, I prefer to work with the days, but some people prefer to think about turnovers. Then let's forecast ahead. So we know where we are at the moment, but let's see if we can get 3 years ahead. So what will the sales be? What will the cost of goods sold be? And therefore, what will the inventories, receivables and payables be, assuming that our efficiency ratios stay the same? Okay, so here is our input information. We've got some growth rates, we've got some margins. It looks like there might be a lot of information, but just think, what do you need? And pick out the things that you need. And remember, what you're being asked for is, what will the working capital amounts be in 3 years' time? Okay, so I will let you have a go at that, and I will assume that you press pause, have a go, and then come back and we'll run through it together. Okay, so efficiency ratios are going to stay where they are. So what are our efficiency ratios? Well, we've got them worked through on the next slide. So days sales outstanding or turnover, remember they are interchangeable, because you could get to the days sales outstanding by taking your revenue divided by the turnover. Sometimes it's presented like that, but as I mentioned a module or 2 ago, to me that's going 2 sides of a triangle to get to just the sales, which is your balance sheet figure divided by your year's worth of revenue, to say how many days worth of sales are we still waiting for. Days inventory on hand comes to just under 73. That's quite a long time, isn't it? So on average, we're waiting 15 days-ish to receive the money in. We've got inventory worth 73 days worth of sales, and purchases, how long we take to pay our suppliers, 126 days. And of course, you've got the equivalent turnover figures in there as well. Okay, so how do we make that flow through? Well, what are we being asked for again? 3 years ahead. So we've got the growth rates given, haven't we, on the previous slide? So we can predict forward with the growth rates, and that gives us 3 years ahead revenue. And then we're given our margins, so we can work forward for our cost of goods sold as well. So the other margin figures are not relevant to us. We only need the one for the year we're looking at, which is 3 years ahead. So receivables, and this one does it through the turnover, but of course you could do it the same way and say, what's my revenue times what's the days, 15.1 over 365 is the other way of getting to your receivables. There may be rounding in those numbers that will affect your final numbers because they've all been done without any rounding within the calculations. So inventory, same thing. You could use the days, and payables, the same thing. Okay. So that allows us to predict what our working capital would be. We could work out net working capital. We could say, well, has there been an increase in working capital? We need to make sure that we've got the cash available to support that. Okay, so nothing new. It's just things look bigger. All right. So the same with this next one, which seems quite big, and there's places where you could, certainly if I were looking at this in the heat of an exam, I know there's a couple of places I could get caught out here. So what we've got is a situation where we're being asked to work out what will appear as basically the non-current assets. So we're asked for the total fixed assets, but it's slightly, well, the problem is we use the word net in two different ways. We want the net book value of the total fixed assets, meaning PPE and intangibles. That's what the word total is being used for. All fixed assets, tangible and intangible, but we want the net book value. So what is the figure that you will see on the balance sheet for the next year? Okay, now we've got quite a lot of information given to us, so I'd like to look at that information and then we'll come back and think about what these instructions mean. So if we look at the information, we've got years 1, 2 and 3 which have happened. Okay, so we've got PPE net, that means the net book value. We've got goodwill. Now goodwill arises when you buy another company. It sits there and every year you check that it should still be there. Were you justified in spending what you did in that company, or do you need to write off the goodwill? So there's no concept of depreciation sitting against it. Okay, the other intangible assets though, they may well have, we don't call it depreciation, we call it amortization, and we don't really call it the net book value, but I suppose it's the same sort of thing, isn't it? So it's the sort of written down, the depreciated or amortized intangible assets. So if we take those top 3, the next line down is the subtotal of those. Okay, so this is representing the way information is provided in the CFA Institute example, and it's not 100% clear. You have to look quite carefully and go, what's adding down, what's not adding down, and exam questions tend to replicate scenario questions that are in the Institute's material. So therefore, we just need to make sure we understand fully that we've got PPE and intangible assets which have had their depreciation or amortization applied, and goodwill which doesn't get depreciated or amortized. Then for that year, you've got the cash that was spent. So the capital expenditure, the additions, the purchases of PPE and intangibles. Okay, so those are separate lines, separate bits of information. And then you've also got what appears in the P&L that year for depreciation and amortization. Okay, so that figure, that amortization, depreciation, will have been applied to get to the figures that are already there in the balance sheet. Okay, so that's the information that we're provided. And then, of course, separately, we've got some revenue. Okay, so they're not presented in any particular order there, it's just giving you separate bits of information. So if we go back to what we're told, all right, so we want to predict forward what the figure in the balance sheet will be that I've put in that subtotal line. So we're told what the capital expenditure will be, and that is linked to revenue. So we're going to assume that we spend the same proportion of revenue on CapEx for PPE and as per the year 3 level, whereas expenditure on intangibles will be at the year 1 level. So that's just attention to detail, isn't it? Goodwill is not going to be written down, and depreciation and amortization is going to be a constant proportion of the opening balance. Opening, okay, not closing, the opening. So this year's opening balance is last year's closing balance, okay, and we're told what revenue is forecast to be, so we have the ability to provide what we think, or calculate what we think capital expenditure will be. Okay, so I'll let you have a go at this, but one last bit of advice, format. If you follow this approach, you will be okay. So we need for year 4, the opening total net book value, right? That's the figure that I gave in that little total thing, plus the capital expenditure on PPE, plus the capital expenditure on intangibles, less the depreciation, which is on PPE, less the amortization, which is on the intangibles, and that gives you the figure that you are after. Okay, so it's not hard, it is fiddly, all right, but we need to just go through the process once. So as ever, I'll assume that you have had a go to give it a bit of time to give it a go, and that when you're ready, we'll go through the calculations together. Okay, so our starting figure is going to be that 10,52572, okay, but the sneaky bit is when we're working out the ratio of depreciation for year 3, we are comparing the opening figure, because the figure in the year 3 column is where we ended up. So the depreciation and the amortization ratios are going to be based on linking the figures that I put the arrows to there. Year 3 depreciation based on opening year 3, which is last year's closing. Okay, so the CapEx relative to year 3 revenue, remember we're given, we are then given year 4 revenue is 1.23%, but the CapEx on intangibles is based on the proportion relative to year 1. So those are going to be what we apply to our year 4 revenue. Our depreciation, sneaky, based on the year before's figures. Amortization, similarly sneaky, based on the year before's figures. So we can now apply the CapEx figures to year 4 revenue. We can apply our depreciation and amortization to the year 3 fixed asset figures, and that will give us year 4's depreciation and amortization. So here we go. Opening total fixed assets, net book value. Capital expenditure, figure that we've worked out based on the year 4 predicted revenue, which was given, and depreciation based on the proportion that we worked out and applied to the year 3 figures, because they're the year 4 opening. So fiddly, as I said, definitely fiddly, and there's plenty of places to get caught out, especially if you're doing things in a bit of a rush. So just take it easy and assume, as I said, that if they do something similar to this, it has to be quite similar, because they shouldn't really be giving you something new in an exam. Okay, so balance sheet modelling of debt sounds like it might be complicated. This definitely isn't. It's just about picking out the key relationships that you're given and making sure you're working with the correct year. So you're asked for the expected gross debt for year 6, and you are given year 1, 2 and 3 figures. So we've got gross debt, we've got revenue, and we've got the EBITDA, so earnings before interest and tax, and also adding back depreciation and amortization. And what are we given for targets? Target EBITDA margin of 6% and gross debt to EBITDA of, and we're given the 3 years worth of targets. And we want to get to year 6. So everything for us is about year 6. So how do we get our predicted year 6 EBITDA? And how do we get, therefore, our predicted year 6 gross debt? So if we go back, we have got a year 6 margin of 6%, and we've got revenue as predicted for year 6. So that'll get us to our EBITDA, and then our relationship between gross debt and EBITDA, we only want the year 6 one, is 2. So as long as we know where we're heading with these numbers, we can work through them, hopefully, with minimal stress. So we pick up that revenue and we pick up the 6% margin target, and then relationship between gross debt and the EBITDA. And that's it. There isn't really anything more. Again, in the underlying module, there'll be lots of words around this, but the basic technique of picking out some key ratios is relatively straightforward. Okay, now of course we can question those targets and whether they will be met or whether we're likely to see convergence to an industry average, but the basic mechanics shouldn't cause too much problem. And in a 90-second question, again, remember that's probably all you're looking at. Now, as I said at the start, we've got the ability to model in much more than just one central expectation of what revenue is going to be or what margins are going to be. So it's relatively straightforward for us to build different scenarios. And we can do that by linking variables together and saying what would be a combined good outcome. So high growth, high margins, etc. Or we could focus on a particular variable and put a range of probabilities around what it might actually be. But these approaches are covered in plenty of detail elsewhere within quants, for example. So the idea of building scenarios or dealing with probabilities and expected values, or Monte Carlo analysis, for example, of just lots of different things that might come with our input variables. It won't be tested in detail here. It's more just a note at the end to say it does make sense to model in the uncertainty. And one way of doing it is, for example, to have a matrix. If you say there's 2 key variables that may change, and just show what happens to our forecast object if we allow the different assumptions of, say, growth or margins, and we can just see at a glance then the sensitivity of our forecasts to changes in the inputs. Okay, now that ends the 3 modules that sit together as a sort of a link to analysts and the production of analyst report. So hopefully you can see them as a unit, see them as a group, but also see that there shouldn't be anything in there that is too concerning. And in the context of what you're likely to be asked in the exam, nothing should be too tricky, too detailed, and you're just following some basic relationships, pretty much all of which have been seen elsewhere in the curriculum. As ever, full solutions are provided at the end of the slides, but do make sure you can rework the solutions that we've done in them to make sure that you are exam ready on these topic areas.